Good afternoon and welcome to Nature's Returns, Investing in Ecosystem Services, a webinar series hosted by the Yale Center for Business and the Environment. My name is Paul Hatanga and I'll be your host for today's presentation. The Nature's Returns webinar series addresses the growing importance of ecosystem service valuation and investment. Each presentation is recorded and available from CBay through YouTube and on the Yale iTunes channel. Today, we are excited to be talking about catalyzing finance through conservation trust funds, trends and lessons for the future with our guest, Katy Mathias. Katy is a conservation finance project manager at Wildlife Conservation Society, WCS, which is an international organization with a mission to save wildlife and wild places worldwide through science, conservation action, education, and inspiring people to value nature. Katy combines experience in finance, nonprofit management, performance measurements, and governance in her role as conservation finance project manager for WCS. She is the co-author of the annual Conservation Trust Fund Investment Survey that is conducted around conservation trust funds to determine their practice standards. Katy also is a project manager of the educational programs related to the Conservation Trust Investment Survey and serves as the consultant to conservation trust funds worldwide. Her role also focuses on broader conservation finance efforts to increase available funding to conservation of biodiversity and protected areas in many places where conservation trust funds work. Katy also led the Secretariat of the Conservation Finance Alliance, a professional association for conservation finance experts and practitioners before its recent transition period. She has over 20 years of experience in management and finance, having served as a consultant to for-profit and for non-profit organizations in organizational effectiveness, executive compensation, performance measurements and analysis, and project effectiveness. Katy earned a master's in public and private management from the Yale School of Management with concentration in strategy and finance, and a bachelor's degree in political science from Tufts University. She lives in the state of Washington, US, and currently serves on 2 nonprofit board of trustees. We are very excited to have Katy today, and we welcome her back to Yale. So during today's webinar, she will kick off the presentation providing some background on wildlife conservation and its work on conservation trust funds. Katy will discuss ways that CTFs use capital markets and innovative financing mechanisms to catalyze funding for conservation, drawing on 3 to 4 case studies. She will also share findings from the Conservation Trust Investment Survey, an annual report by WCS, and the Conservation Finance Alliance that analyzes the investment management policies, practices, and results of CTFs around the world. Guests, after the presentation, we are hoping to leave a fair amount of time for Q&A, so please make sure to submit all your questions and we can have them in depth discussion with Katy. You can type your questions in the Q&A section of your screen throughout the presentation, and we'll be ready to collect all of them and present them to Katy for answer. All right, so let's get started. Katy?
Yes, Paul, thank you so much. And it is great to be back at Yale, even if it's virtual. If I could have the next slide, please. A quick overview of the agenda for today. Paul has given a good summary. I'm just going to give a quick amount of background. Share some information about conservation trust funds, what they are and where they work, give some case study examples of how 4 trust funds are working to promote conservation of biodiversity in the countries where they operate, share some findings from the Conservation Trust Investment Survey, which, as Paul mentioned, is the annual study of investment management policies, practices, and returns from CTFs, and then invite discussion and conversation, which I look forward to. If we could have the next slide, please. Paul has given a great deal of background, so I won't go into much detail here, except to give a little bit of more context on the Conservation Finance Alliance, which is a global professional organization for conservation finance experts and practitioners. Its mission is to promote awareness, expertise, and innovation in conservation finance globally. We have over 700 members from around the world, from a variety of institutions, including academia, the government sector, as well as multilateral government organizations, nonprofit organizations and NGOs, and of course, some conservation trust funds. So we do invite and encourage membership. If anyone on the call today is interested in learning more, the website is cfalliance.org, and you can either join as a member or sign up for the newsletter. So we hope to see more people there. If I could have the next slide, please. So conservation trust funds are an interesting combination of a finance mechanism and a catalyst for other finance mechanisms. They are private, legally independent institutions that provide sustainable funding for biodiversity conservation. Their primary role is grant making. So they serve as grant making institutions. They fund protected area management, research, capacity building, conservation programs, work with civil society organizations, with local and indigenous communities, with governments, to pull together a wide range of stakeholders to promote biodiversity conservation and biodiversity conservation awareness. The first conservation trust funds were founded in the 1990s, so they are approaching 25-ish years old, close to 30 years old in some cases. We have, it's a little hard to get a complete survey of the number of conservation trust funds out there. There are a number of us keeping track of them. Our estimate is that there are over 100 that are either fully operational, in a stage of creation, or in some cases, they were created, did their work, and are winding down and replaced by new institutions. In aggregate, they are investing over $1 billion in the capital markets to fund their conservation work. Now, they don't invest in aggregate, but if we tally up the funds that they have collectively invested in the stock market and in the capital markets, over $1 billion. We see them in areas of high biodiversity and usually in developing economies where national budgets do not have adequate resources to support protected areas, to support biodiversity, and where additional financial support is needed from the international community and from additional institutions. A lot of the historical driver of conservation trust funds was that international organizations and NGOs tended to do a lot of project financing. They would come into a country, maybe set up a 5-year project, buy some jeeps, pay for some rangers, pay for some scientific research, and at the end of that 5-year period, the project would be over and there would be no sustainable long-term commitment to biodiversity because the NGOs or the international agencies would pull out. So an advantage and a critical importance of conservation trust funds is that it created local commitment to biodiversity conservation by creating long-term lasting institutions in the countries where biodiversity is highest and most critical. So as I've shared, and if we could have the next slide, please. They're operating in our latest count in 68 countries around the world, again, close to 100 conservation trust funds. You can see from the shading on the map, the countries where conservation trust funds are active and highly functional. Those tend to be near the equator or south of the equator. In addition to the ones that you can see on the map, there are another 14 small island developing states that were too small to shade, but are critically engaged in conservation trust fund work and protected area management work. And newly in the last few years, there is a new global fund for marine conservation that is not geographically specific, but in fact works worldwide on marine and coastal conservation needs. If I could have the next slide. One of the critical resources for conservation trust funds is networks, which enable them to come together, regionally and globally to build knowledge, to build capacity, to collaborate both programmatically and administratively on the work that they do and on efficiencies around the work that they do. In Latin America and the Caribbean, there's the Red Lac Network, which is the oldest network of CTFs. It has over 20 members, conservation trust funds working from Mexico down to Brazil, and holds a huge annual assembly of conservation trust funds, in fact, from around the world, who come together for knowledge sharing and collaboration. In Africa, it's the CAFE Network, the Consortium of African Funds for the Environment, and similarly has over 20 members, institutional members of conservation trust funds. Together, they partnered on a project called Project K, Knowledge for Action, which enabled South-South collaboration among conservation trust funds. And the newest network is APNet, which is the Asia Pacific CTF network, recently formed in the last 2 years, so that conservation trust funds in the Asia Pacific region can come together for similar collaboration. As the Conservation Finance Alliance, we also collaborate with these 3 networks and with other conservation trust funds to create and share resources that support the CTFs. These include the practice standards for conservation trust funds, which is a set of voluntary evidence-based norms and standards for the effective and efficient running of conservation trust fund. Those include governance, strategy, grant making and operations, financial and asset management. There are currently 6, and we're engaging in a project to add 4 more. There's the Environmental Funds Toolkit, which is a database of documents and policies that they share amongst each other for learning from what one another are doing, and so they're not reinventing the wheel. An Environmental Funds Working Group, collaborative knowledge sharing and generation of new ideas and innovations, and a number of workshops for capacity building purposes, including an investment management workshop on the principles of investment and endowment management. So we could have the next slide, please. One of the most critical things for conservation trust funds is that they have diversified funding streams. So initially, most conservation trust funds were formed with a single funding stream. Often it's an endowment. In many cases, the early conservation trust funds were founded through debt for nature swaps, where a country's underwater debt is partially forgiven and partially able to be paid back in local currency, which goes into a trust fund to support newly created protected areas in that country. And external global donors help to fund the debt buyback in order to achieve the conservation objectives that they want to see. But that only creates one funding stream. So the most successful CTFs over time mature and diversify. And this is sort of a schematic model, which shows some of the, sorry, my screen just went squirrely. I'm not sure if that happened to others as well. Oh, it's back. Shows some of the diversification of funding streams that they might use. So they certainly use endowment capital, and those endowment returns go into the annual budget. In addition, they often have sinking funds, which are funds that might decline over a 20-year period. They invest the capital as well, so they're using some of the returns for that, as well as some of the capital over time. They're increasingly using payment for ecosystem services schemes that they help to model and put together, and then manage the revenue streams as well as the payments. They are catalyzing project funding from around the world from international donors. And so they're managing incoming grants and project funding, sometime on a 3, 5, 10, or longer year basis. Increasingly, we're seeing conservation trust funds as the independent and accountable conduit for biodiversity offset payments as countries are doing more and more development. They are where they can't mitigate or avoid environmental impact, then they are making offset payments, and they often want to use a independent institution for those transmittal of those payments. So those also become part of the funding mechanisms for the trust funds to, again, move money to biodiversity conservation expenses. And we see a number of increasingly interesting fundraising models, whether it's marshaling resources from the private sector, using some consumer-driven fundraising models like grocery store roundup schemes, where you round off your grocery store check to the nearest whole number, and the increment goes to a nonprofit, and often in these cases to an environmental NGO, or mobile phone driven fundraising models, sort of not unlike crowdsourcing, in fact. And those will all go into an annual budget that then pays for the overhead costs of the trust fund, the grant making programs, and if they're doing a PES program, then there may be some other direct payments that they do as well. We are also increasingly seeing program-related investment where the conservation trust funds are putting their capital into conservation enterprises through startup grants, through revolving loans of working capital, where they can use a small portion of their endowment capital to foster and improve programs and even businesses that have a beneficial conservation impact. Those can be companies, they can be cooperatives, they can be long-term holdings of land investment where the trust fund can own land that might be buffer or corridor to a protected area. It might be productive agricultural land that can be used more sustainably or more beneficially for biodiversity conservation, where there are productive returns, where they are generating, again, some return to their own invested capital, but even well beyond that, they're seeing conservation benefit and conservation impact. So I'd like to share a few case studies, if I can have the next slide. And I think these are representative of a number of the trust funds that are out there. So one of the newer trust funds is the Seychelles Conservation and Climate Adaptation Trust. It's known as SECAT. It was created in 2015. And shortly before that, the Seychelles made a significant commitment to put, I think it's 30% of their exclusive economic zone into marine protected areas. So a lot of the the creation of SECAT was to ensure that there's sustainable financing for the marine spatial plan. At the same time, the Seychelles are facing a significant impact from climate change. As a small island, they are certainly seeing significant erosion. I flew to the Seychelles a few years ago. The runway is literally eroding and getting shorter. And as a country that relies heavily on tourism, that's a significant problem. Their economy is threatened by climate change. And so in addition to promoting marine conservation, part of the trust fund's role is also to promote economic resilience and diversification in the face of climate impact. They were created by the first debt for adaptation swaps. So similar to a debt for nature swap that I described earlier, in this case, specifically to promote and finance the needs for the country to adapt to the impact of climate change. They have also launched the first blue bond, so similar to a green bond where the proceeds go to environmental projects. In this case, the blue bond is going specifically to promote innovation in the fisheries sector. So the proceeds of the blue bond will build the fisheries sector, help to diversify, pay for some no-take periods, which will allow the fishers to have an income while they're not fishing, to allow the stocks to have time to regrow. And the proceeds will, from the increased tax revenue as the fishery sector becomes more robust, will then go to pay back the interest on the bonds. They are also creating an enterprise fund or an incubator, which was going to support growth of the blue economy and improve economic diversification in the Seychelles. So that's one example. We can move on to the next one. The Mulanje Mountain Conservation Trust is an example of a trust fund that has a very specific scope. It was created a long time ago, in 2002, to specifically support biodiversity research and the conservation of biological diversity and sustainable resource use of the Mulanje Mountain Forest Reserve, which is in southern Malawi, the beautiful mountain and ecologically rich and diverse site. And this conservation trust fund was created with a modest endowment specifically to protect the ecosystem. And critical to that is supporting the communities that live on the mountain, that draw natural resources from the mountain, that have a vested interest in the health and protection of the mountain, but at the same time are also needing to live. So they need to be able to farm, they need to be able to support themselves. They are not, or at least until Mulanje Mountain Conservation Trust created an enterprise power generator, they did not live anywhere near the power grid, which affected obviously their productivity, their livelihoods. For a long time, Mulanje Mountain Conservation Trust allowed its endowment to grow. It worked entirely off of grant funding from bilateral and multilateral donors that supported projects over time. One of the interesting innovations that they have made in the last 5 years is to create a wholly owned company that is a social enterprise to bring electricity to the mountains. So they've got a mini grid. They're one of the first allowed by the National Energy Company to create a separate producer, and it's bringing electricity to the local communities, which in turn reduces pressure on the reserve itself. It's a very interesting project. They have actually now, I think, are up to 3 different generators, 2 or 3 that are in active use. So we can move to the next slide, please. Fumbio provides a contrast to both of those. It's one of the oldest conservation trust funds, founded in the mid-90s. It's probably one of the 2 largest conservation trust funds in existence. Their initial responsibility is to fund the management costs for Brazil's system of protected areas, which is an enormous scope of responsibility. They have grown and diversified over time to become a significant powerhouse for conservation and environmental protection in Brazil, partnering with government on policy, on implementation of conservation programs, of diversifying the number of programs that are in existence throughout Brazil, throughout, I think it's essentially all the biomes of Brazil's extremely diverse biodiversity. In 22 years, they have made $614 million in disbursements of grant funding to conservation. They've managed 284 projects for 322 protected areas, 233 benefited organizations or civil society organizations that have received grants and partnered with Fumbio on biodiversity conservation projects, 20 indigenous homelands that they have worked with and protected. They have become, as I mentioned, a really diversified institution that has a depth and breadth of expertise and impact. So they are now accredited by the Green Climate Fund, which means that they can receive funding related from the GCF. They've been approved as an implement agency of the Global Environment Facility, so they are able to operating as a grant-making or a conduit of JEF funds within Brazil. The process of becoming accredited for both of those is significant and time consuming, and represents really the significant amount of work that they have done to evolve as an institution into one of the most sophisticated NGOs working in biodiversity conservation. They are also managing ARPA, which is a project finance for permanence project where a significant sinking fund, and I'm going to admit that I do not remember the dollar amount of the sinking fund, through these project finance for permanence programs, a huge sinking fund is created to decline over a 20-year period at the same time that the national government increases its responsibility for protected area finance. So the sinking fund may pay 95% of the cost of managing a protected area in the early years, while the government's paying 5%, but as the sinking fund declines over a 20-year period, the ratio is continually shifting, so that by the end, the government has taken over 100% of the financing costs and the responsibility for bringing together diverse financing mechanisms. It might not just be the national budget. It may be other public-private partnerships that they create, as the sinking fund has lesser and lesser responsibility for funding the national park system. There, just as a side, there are project finance for permanence initiatives significantly in Brazil, a new one in Bhutan. I think there's a new one in Costa Rica. It's an interesting model for paying for biodiversity conservation. And donors are excited to get behind it because it's a major leveraging of resources towards moving towards sustainable funding. So if we could have the next slide, please. And my fourth example is Yayasan Kahati, which is the Indonesian Biodiversity Fund. Kahati also, like Fumbio, is a mature conservation trust fund, one of the oldest. It's founded to support biodiversity conservation and the sustainable use of natural resources in Indonesia. Similar to Fumbio, Kahati is an example of a trust fund that has created so much institutional capacity in grant making that as NGOs or government agencies recognize the need for new trust funds within Indonesia or within the region to support conservation, rather than creating a new institution, they recognize that it is easier and better to just create a new trust fund within the Kahati umbrella. And so as new protected areas are being supported with long-term endowments for their support, Kahati becomes the manager of those. And they're one example of several conservation trust funds that have established so much institutional capacity that they are frequently asked to take on more trust funds to support more protected areas. Their funding streams has come from endowments, sinking funds, and project funds, but they're doing something very interesting, and I think the only one that I've heard that's doing this, which is they have leveraged expertise in investment management to create investment products that are traded on the Indonesian Stock Exchange that promote environmental responsibility. They're essentially environmental ETFs or environmental mutual funds, where Kahati takes the responsibility for identifying the countries that are going to be in the index. They're essentially throwing their weight behind their ability to vet the environmental and biodiversity conservation credentials of these companies, the environmental track record of these companies. They're putting the Kahati stamp of approval on the companies that are within the index. And then the indices are traded on the stock market, and investors who are looking for an environmental screen in their portfolios will look to these products. In exchange for the work that they do in the screening of the companies, Kahati then gets a management fee or a fee from the management company that helps to support the conservation work that they're doing. So not only do they promote companies that have the best environmental track records, but they're using the investment market as a way to generate additional funding for biodiversity conservation within Indonesia. So if we could have a next slide, please. As I mentioned, one of, or I should say two of the financing mechanisms that conservation trust funds rely on are sinking funds and endowments, that they are investing in the capital markets and using the returns to pay for their grant making and their conservation work. In many respects, conservation trust funds are like any other institutional investor or any other, let's say, endowment that we would see, whether you think of colleges and universities or foundations. Like most endowments, they have similar investment goals. They are looking for a sustainable income stream that pays for the work that they do. They are looking for long-term growth over time to cover inflation, the idea of intergenerational equity, that future beneficiaries of the endowment will have the same purchasing power as current beneficiaries. They are certainly looking to minimize capital loss, and as many of their donors are foreign governments who have are using their taxpayer funds, those donors certainly do not want to see that there has been a significant loss in the stock market of their taxpayers' money. They are, of course, looking for sufficient liquidity to avoid selling at a loss in the event of a downturn. And they're using the same prudent investor standards that you would expect of institutional investors in the US, in Europe, anywhere else. But they have some unique challenges. They are operating in countries that are often very high inflation, seeing double-digit inflation in some years. And so while they're trying to think about how to cover inflation over time, they have to think about how do they invest to cover significant inflation. They are also managing a currency exchange risk that certainly a US-based foundation or US-based university is not dealing with on anywhere near the same level. They have to time when they take distributions from their endowments if they're investing offshore, so that they are managing the which they're spending to make grants. We're seeing in many countries that there are legal restrictions on offshore investing. I mentioned that some of the trust funds were created through debt for nature swaps, where the government put local currency into the trust fund. In many cases, those countries do not want to see their local currency moved offshore. And so it often takes, in fact, acts of parliament to allow the trust funds to convert their local currency into a hard currency for offshore investing. So that's a challenge that they face. And when they're not able to do that, then they have to invest in their domestic markets, which may not have as many opportunities for diversification. And the other issue that we're seeing them face increasingly is that global investment firms, as the level of scrutiny in their own risk management increases, are doing extensive due diligence on whether they're willing to take funds from many countries. This has to do with concerns about money laundering. It has to do with concerns about terrorism. They need to be certain that the funds that they're taking and investing are thoroughly vetted. And because of that, some investment firms have ruled out some countries entirely. And in other cases, they make the Conservation Trust Fund jump through an enormous number of due diligence hoops to make sure that the funds are legally acquired. For those of us who work in conservation trust funds, we know that the standards that go into creating a conservation trust fund, we know that that these funds have been already carefully vetted. The institutions are established according to international norms and standards, but the investment firms don't know that. Conservation trust funds are comparatively small slice of the market, and the upshot is that the trust funds often have a hard time finding investment managers willing to take their money. So I put that out there as context as I talk a little bit about some of the investment experiences that the trust funds have. We can move to the next slide, please. As Paul mentioned, the Conservation Trust Investment Survey is an annual study that we produce at WCS with the Conservation Finance Alliance that looks at the investment management policies and practices and results of the conservation trust funds around the world. It was modeled on the Nikubo study. So if you hear in the news when the press releases come out to say the Yale endowment outperformed other colleges and universities, it often is the Yale endowment. That's based on the Nikubo study. It looks at over 900 North American colleges and university endowments. And we, on a very small scale, modeled the CTIS on that study. The CTS is used annually by Conservation Trust Fund leadership, by their boards, by donors who are looking to understand how their contributions are being invested and used, by the investment professionals themselves, and as a model for new and emerging conservation trust funds to do their planning, their business planning, their financial modeling to know what's possible and what's likely. We can move to the next slide. I'm just going to share some data from the most recent study, which is for calendar year 2017. We are just now collecting the data on calendar year 2018. So the participants, to give you a sense of the range of those who participated in the 2017 study, range from the 40-ish% of the funds that have 0 to 10 million in invested assets, up to the 17% who have assets over 50 million invested in the capital markets. Those are US dollar equivalents. And then roughly 20 to 25% that are in the 10 to 20 million range and the 20 to $50 million range. Across the board, they range from the smallest that are about 2 million in assets and responsible for a single species, up to well over 120 million in invested assets, responsible for an entire national protected area system. So the scope of responsibility and the size of investments varies widely across them. Geographically, they're more or less evenly distributed between Latin America and the Caribbean, Africa, and the Asia Pacific region, toward Eastern Europe, Western Africa, and Western Asia, and are based in Germany and investing in Germany. And that also includes that global fund that I mentioned earlier. So if we move to the next slide, some quick sense of results. We look at the results on both a nominal and a real basis, before and after inflation. The nominal results tend to be quite high because they include the trust funds that are investing in their own domestic markets, often in fixed income products that have returns that reflect the inflation within that country. So they might be earning double-digit returns on a nominal basis, but closer to 4% on a real basis. And that's why we look at both. You can get a sense from the blue line, which shows the nominal returns, and the red that shows the real, what the spread tends to be. And it's usually, on average, it can be a 3 and 3.5% drop from the nominal to the real. If I can have the next slide, please. What we're seeing over time, and this graph shows the compound annual returns on a rolling 3-year basis. So for example, the data point in 2012 reflects the compound annual growth return for the 3 years leading up to and including 2012. We obviously saw some spikes as there was some volatility a few years ago. What we've been seeing over the last 3 to 4 years is that the returns are hovering around 4%. In this case, I'm showing you the nominal returns. But when you consider the impact of inflation and the need to spend 3, 4, 5% of the capital base each year for grant-making purposes, we're starting to have some concerns about whether the assets are being invested in a way that meets the needs of biodiversity worldwide. So if we can see the next slide, please. The reason for that is that we're tending to see the trust funds, again, on average, there are certainly a high number of top performers that are more diversified, but we're seeing an overweighting to fixed income and an underweighting of equities. The graph on the left shows the typical average asset allocation over the last 10 years, where equities and alternatives are a very small percentage of the average portfolio compared to fixed income in purple and cash in green. Often we're seeing 50, 60, 70% of the portfolios are in fixed income products. We contrast that with the results from the NACUBO study, the NACUBO Common Fund study of college and university endowments, where 85 to 90% of the portfolio might be in equities and alternatives. And when we look at what's needed to drive growth over inflation over time, that's going to come from equities. And so when we contrast, this is the graph on the right and the line on the bottom, which shows how the conservation trust funds have invested their endowments. Fixed income is, again, a significant percentage of the portfolio. So if we can see the next slide, please. What we've been seeing as a trend is that the conservation trust funds investment strategies are erring, as I mentioned, on the side of income and capital preservation at the expense of growth. It's driven by a sense of risk. They are more comfortable in fixed income products. They are more comfortable in many cases in their own domestic markets as opposed to the global markets. And in their interest to avoid one kind of risk, which is capital loss, they're actually incurring a different kind of risk, which is the risk that their endowments are not going to be able to meet their needs in the long term. We are engaging in a number of education and capacity building strategies to reverse this trend. It's really a question of education and understanding risk and diversification. And so we have workshops that we've been doing in person, and we're working on making those workshops available as an online tool so that we can reach more people. One of the other tools that they have available to them is investment pooling, where several conservation trust funds pool together with one investment consultant to improve their access to products and reduce their fees. There are several models of these, and they range from pooling assets to actually pooling investment committees, not just assets. And in some cases, trust funds that were actually created as umbrellas from the start to serve as both administrative and investment pools for smaller trust funds that operate within that umbrella. So just, I think, 2 more slides to go. If we could have the next one, please. The other observations I'd like to make have to do with conservation trust funds as institutions. What we have seen over time is that the conservation trust funds are achieving the objective of creating stability and sustainability within the countries where they work. They are becoming leaders in government policy, advocacy. They are becoming leaders in creating awareness. They are catalyzing resources to fill the funding gap for biodiversity conservation. They are also, in times of political and economic turmoil, they have been a stable force, and that provides a sense of transparency and continuity for international donors who may not, for whatever reason, have confidence in the national governments, but do have confidence in the conservation trust fund. So whether it's international donors, private sector companies that are looking for conduits for biodiversity offsets, the conservation trust funds have been highly effective at serving as independent, transparent institutions. So just one more slide to talk about a little bit of what's on the future. We're anticipating the continued use of trust funds. There are new trust funds being created every year, sometimes on the order of 3 or 4 new ones coming online. They're valuable, again, source of stability and resources for protected area management. We're seeing an increased growth in the role of conservation trust funds to support climate adaptation and mitigation, as we saw with the SACAD example. We see an increased role of pooling, whether it's for administrative purposes, financial management, and an increased collaboration programmatically, as well as conservation trust funds that share a common responsibility for a shared ecosystem. This happens both terrestrially and for marine and coastal, where they come together to collaborate on conservation programs that cross boundaries. And an increased use of the conservation trust funds as testing grounds for new and innovative mechanisms, more use of payment for ecosystem services schemes, the use of the conservation trust funds as a conduit for biodiversity offset payments. Several new conservation enterprise incubators are coming online. We're seeing, as I mentioned, the new blue bond is joining green bonds, and there are other use of nature bonds being explored. Public-private partnerships and the drawing of the private sector into the conservation space as collaborative partners in the process, and an increased use of insurance-based mechanisms, which I don't have time to go into, but if you're interested, there's a really interesting scheme being developed in Quintana Roo in Mexico, where the hotels have come together to buy into an insurance product that relies on the storm protection of the reef system and ensures that the hotels are essentially compensating nature for the benefit that it provides them. So I encourage people to Google that one because it's very interesting. So with that, I can just move to the last slide. Again, I encourage people also to visit the Conservation Finance Alliance website. And hopefully I have not talked too long and we have time for discussion.
Thank you so much, Katy, for this great presentation. And as a reminder to our listeners, we might have a few minutes for questions. So feel free to send in your questions through the Q&A section of the screen, and I'll direct them to Katy. So Katy, actually there are two questions that maybe you touch on. So in thinking about the stakeholders involved in the CTFs, one viewer wants to know whether there are banks or multilateral sectors, agencies like the International Finance Corporation or the World Bank that are interested in supporting CTFs. So that's one. And you could tie that with this question. So you mentioned about many different financing models or new fundraising strategies like the grocery store roundups. Are you seeing a trend that CTFs are actually engaging common citizens to try and raise financing?
Great questions, both of them. I'll take the multilateral ones first. Absolutely. Multilaterals are perhaps some of the biggest donors to the conservation trust funds, and that includes the development banks. The Global Environment Facility is possibly the single largest donor to the establishment of conservation trust funds around the world. I think they have funded at least 50 of them at the last count. The World Bank often as the implementer of GEF funding. The development banks get involved, for example, in the blue bond I mentioned in the Seychelles by providing concessionary financing and backing the interest rates so that there is some additional protection for investors. And KfW, which is the German Development Bank, is also one of the largest donors to conservation trust funds. So that's a bilateral as opposed to a multilateral, but very critically involved in initial financing and in collaboration as new financing mechanisms come on board. The question about whether citizens are involved in the funding, it varies a lot by country. So one of the grocery store roundup scheme I mentioned is in Indonesia, but in urban areas in Indonesia. We are seeing an increasing use of crowdfunding and mobile phone-based crowdfunding, but primarily in Latin America.
Mm-hmm.
I would say general population participation is least common in Africa that I've seen so far. But then again, it depends a lot on whether the audience is urban or rural. So you're certainly much more likely to see crowdfunding type programs in urban areas.
Great. Thank you very much for that.
Sure.
I think we have just two last questions that we will close with. So the first one is, you mentioned your goals to increase education through, for example, workshops that CFA and WCS are engaged in. So what do you see as your biggest goals and challenges in the future, particularly to support like CTFs that are emerging or new ones that actually require some level of capacity? And if you could tie it up with this last one, so the 10-year annual reports that CS and CFA have done, you've definitely tracked some data over time. And I think there's interest to know, like, how have the metrics changed through your analysis, and what new metrics do you see as, being critical for future monitoring of performance of CTFs?
Also great questions. So the biggest goals and challenges, I would say from an education standpoint, actually, I think it's probably broadly, resources are always the biggest challenge. So there is a universal agreement that more education, more capacity building is desired. It's really hard to figure out who will pay for that. So while the conservation trust funds themselves are they're the consumers of the education, but they rarely have the resources to pay for. Certainly, they don't have the resources to pay to send a couple people to a week-long workshop. So we have to be opportunistic about having workshops in collaboration with existing conferences where people were already going to be traveling. I mentioned that REDLAC has an annual assembly. CAFE does as well in Africa, and APNET in Asia will start to do them soon. And so as trust fund leaders and board members, we're already going to be traveling to those. We try to tie workshops together with those. But it's also a question of looking to the donor community to help to pay for some capacity building. Mm-hmm. In looking at how the metrics have changed, that's a really good question. I mean, I can just say on the investment side, what we have been looking at, we actually didn't used to look at real returns. We used to look only at nominal returns. And what we found is that there's so much variety, because as I mentioned, you have some trust funds that are investing in their own domestic markets, and you can't draw any conclusions about investments in in a diverse set of domestic markets. So we started looking at real returns because that at least gave us a little bit of normalizing. And we have started measuring different types of diversification, not just by asset type, but by whether the investments were held domestically but invested in offshore products versus held offshore and also invested in global products. So we're looking at the range from domestic products and domestic currencies up to global products and global diversification. The question, I mean, the biggest question on metrics, I would say, is that conservation is very hard to measure. And anybody who works in this space knows that measuring the impact of biodiversity conservation is a complicated question, because in some sense you're trying to measure a negative, right? You're trying to measure the avoidance of loss, and in other cases you're trying to measure improvement, but standardizing those across ecosystems, regions, species is challenging. And I think that's probably the biggest metric struggle that the global community is having, is how to really, how to clearly demonstrate impact. And it's critically important as we start to increasingly look at ways to draw private sector funding and private sector investment into conservation. Investors are looking, in often cases, they're looking for market rates of return, but if they're willing to accept less than market rates of return in exchange for conservation impact, they really need to know that there's clearly measurable conservation impact. And that's I wish I had a good answer for that. All I can say is there are a lot of people thinking about it.
Right. Thank you. Thank you very much, Katy, for this exciting discussion we've had. So unfortunately, listeners, we have run out of time, and would like to thank our speaker, Katy Mathias from the Wildlife Conservation Society, for this engaging discussion. So the recording of this webinar will be available on our YouTube and iTunes channel. So please check back for this later, and you can be able to download them for your later use. And last but not the least, be sure to check the CBE website, the Center for Business and Environment at Yale, and the newsletter for more information on the upcoming webinars. So until next time, and on behalf of my co-host, Amy Touget, who was covering everything behind the scenes today, this was Center for Business and Environment at Yale, and have a great day. Thank you.